everybody, welcome back to another episode of the Investor Motivation Podcast. You are in the new year with myself, Amy Lehman, and we've got
Rob Gowdy. How you going?
I'm brilliant, how are you?
Happy New Year, and Happy New Year to everyone. It's 2025, this is our first week back. Started on the 8th and we're now on the 10th, so on Friday we're back into it.
2 days in and in full swing.
Yeah, it's got really busy.
It has, which is brilliant. And thank you for all the podcast listeners, all the TikTok watchers, which we also always do a live of the podcast on TikTok. So we're seeing a lot of TikTok and podcast listeners in appointments now, which is amazing. Yeah, it's
fantastic. Lots of scenarios and helping lots of people, that is what it's all about. What are we chatting about today, Alice?
Well, actually, if anyone hasn't heard it, it is also a good listen, but we will run through some of it today. Rob did a podcast with James Wrigley, who's another financial advisor, for a financial advice podcast, so more tailored towards advisors than our client base. So we thought we would do one for you guys specifically, but mainly on how Consortium as a business operates and why we do operate in the way that we do, really.
Yeah,
because we are quite different to most of the industry.
Yeah, there's a lot of what we do that is not easy and is not the other 96 or 7% of what the industry does in terms of the way we look after people's money. And there's been obviously a long history of experiences that I've had over time that have really obviously moulded that.
26 years in the industry has shaped the way
and
tailored that.
That's right, and it's not only for my some of my own experiences in terms of investing has led me to, how do I want things done? How would I like things done?
Yeah.
Yep.
You as an individual, how you do things for yourself, that is the way you would want to treat your clients.
That's right.
Yeah.
And that's where, and I can't, it was going back, all the way to the early 2000s where, and this is where we'll chat about some of the physical case studies that I went through personally, or that I saw clients experience that led to, there's some flaws here, there's some things that I don't agree with, and then built a way of doing it that suited more so.
Yeah, and this is, I agree in what you say, that we are different in the way we do things because it's harder for us as a business, and that is really because we do things the way we would want things done for us. So there is more work involved on our back end as Consortium, but for the clients it's great. So
and it's also acknowledging that the other way, the other bits that I didn't like, none of that is wrong technically. It's more the norm, so it's not wrong. There's some flaws there that I didn't appreciate as an advisor on my client's behalf, or myself as a as a retail investor.
All right, so do you want to start at the start of your journey?
I think so. So that means we're going back to the start of March 98. So 25 years old.
Ooh.
Great. Yes. Was someone born there? Were they? I think you were. 98 baby. That's when I started in financial planning, and so what I learned very quickly there is that there was products to be used, and you would use the Colonial Mutual Master Fund, and you would put money into these master funds, and you would then buy the managed funds within those products. And there was always a layer of different fees there.
Which I think I can relate that to something for today's product market. Maybe like a raise account where you have this account that's got a fee, and then within that you choose an investment option which also has fees.
So and that's whether it's industry funds or retail funds. In the superannuation world, it's they are a product, and then you select your investments within that. So this is where I'm saying it's not wrong, but in some instances there's what I believe, just based on my experiences and what I've seen and what I've observed as an advisor and as an investor, where I think some things can be improved. When it comes to superannuation, going to a self-managed super fund, which gives more flexibility in terms of the way we invest, that's actually not needed now. because we can do this within Hub24, within Australian Super. There's lots of direct options. And that's a big part of where I eventually got to with the advice that I give, that it is more directly orientated with as little amount of product as possible. And we'll go through that as to why we got there. So when I first started in 98, I soon learned there was a very product-driven environment that, as an advisor, we would recommend product A, we would take the check, and we would send in an application form, and Colonial, or whoever was at the time, would invest that for us and go into the funds that we would select. So and I really didn't question that at all. If we wind the clock forward, a few early years later, we had a family relationship with a stockbroker at JB Weir, a very reputable business. Then during the GFC, National Bank ended up buying JB Weir, so that bank, I think, possibly still owns it. But there was it was a family broker. So the Gowdy family used this stockbroker, and also some business associates of our family also used him. And what happened was, I remember getting the call saying, Rob, I think we should sell Woolworths because it's ex-growth, as in it won't grow anymore. I think it's done the best it could do, and we'll sell that and we'll buy this. And I don't remember what this was. But within 2 weeks, I heard that the business associate / family friend was called within 2 weeks of that conversation, and the discussion was, hey, I recommend you should buy Woolworths. And now whether there was a sell then a buy, I can't remember that part, but it was a complete contradiction, and I thought, churning. So I learned what the word churning means, and it was just, a transaction, to have people moving meant people got paid. And
that brokerage commission that broker received, obviously, they just wanted to make trades to make money for themselves, which is not obviously in the client's best interest.
So that was one learning, and so I thought, right, if we ever have a direct offering approach, that we will make sure that we never make a cent out of brokerage. So if we're looking after ongoing clients and we're buying a range of businesses, we are not going to be incentivised to have anyone moving. So that was probably one experience. And then, so the next experience that I had was really the managed fund world. And this goes back to, during 2000, the tech wreck. So the tech boom where markets went up substantially, that was unwinding between 2000 and 2003. And I'm pretty sure it was around the 9th of March 2003 is where, just by sheer good luck, I picked the bottom of the market. So they all say no one rings a bell when the market hits the bottom, so you don't know when to invest. I got extremely lucky. So I won't say that that's my smarts or anything that I can replicate. We'll call it luck. But I took out my first margin loan. $80,000 was not that old, reasonable risk for me at the time. 80 grand was a lot of money back then. And so I put that in at the bottom of the market, and by the time we got to June, I don't remember the numbers exactly, but it might have been a capital gain on the managed fund. I think it was the Colonial First Aid Imputation Fund. Might have been 30 grand up. Big win in a short amount of time. Now, of course, I didn't sell anything. It was still sitting in the managed fund. And at the end of that financial year, when my tax return came in, and I said, oh, what capital gain? He goes, oh, that's from your investment. And I said, but I didn't sell anything. He goes, oh, well, that's where obviously the fund managers internally realise capital gains.
They distribute that out to everyone that's in that product.
So whatever, so I inherited a lot of capital and unrealised capital gains from, I don't know how many years, that were realised in that year that I then paid tax on, although I did not personally sell anything. So I thought, oh, okay, well, that's a bit of a flaw. So that is a product that's built for, one product built for many clients.
Scalability.
So it's an amazing business model, but not ideal for clients where you're going in and inheriting someone's, the unrealised capital gains from years prior. And where I saw that affect a client where I made the mistake in hindsight, invested at the start of June, and then copped the capital gains, which affected Centrelink and also tax outcomes for the clients.
1 month later.
1 month later, and all of a sudden, so that was just some learnings there. Now, a lot of these tax issues, when it comes to superannuation, that's not really a problem because we're talking about a low and also a no tax environment. So I'm not overly worried about that unrealised capital gain stuff within the superannuation environment. But when it comes to investing into our individual names, and if it's appropriate, this is going. We've been doing this for 20 years. A self-managed super fund, where there is no platform, there is no managed funds. If we like Microsoft and Visa, we buy directly. So we don't have to do that now. But if it's non-superannuation, we're often off platform. We're not going into a wrap account.
No.
We're not going into then to manage funds. We actually go directly into the client's name. And we'll go and buy Microsoft and Visa and a range of businesses that give a lot of diversification if appropriate.
And then that gives us that ability to choose to sell assets when we want to sell them and be able to strategise around minimising that capital gains tax rather than you don't know what that tax is going to be at the end of every financial year, and it's just you either decide at the time very quickly or preemptively do something to minimise that, or it's a part of your tax bill.
So that's so it's these things that have shaped the way that we do things, and it's the conversation that James was quite interested to have with me, because it's not the norm for advisors to be choosing direct businesses like Microsoft or Visa and all these businesses that I've been talking about for 2 decades or more now. But it's been an incredible way to do it, and it's a point of difference. I find that the people that are attracted to what we do are often self-employed people, and they really like to know where their money's at.
That little bit extra control as well on exactly what businesses. We obviously do a lot of education with clients front end before they do become ongoing clients, so by then they know why we avoid certain sectors, and I think they definitely appreciate that we can just buy the things we like and we don't buy an index that has all that muddy stuff that we really don't want, but are just a part of it. So it's that really pointed investing and knowing why you're in that and enjoying it, being interested.
And I think there's a couple of other case studies, again, just my experience as an advisor. One was during, and these are things that probably only work out, that was a benefit not being in that space. So one was during the GFC, there was a business, and we've spoken about this one before, Oaks Prime was a stockbroking, and they would firm, they would set up margin loans, and they would take over custody of clients' assets to go as security for the client's loan. And when everything went bad during the GFC, which everything went bad, they just sold down these clients' funds. They didn't. It wasn't a conversation. Hey, do you have more money to put in? And I think it was ANZ and Merrill Lynch were behind a lot of this debt. And I remember there was one guy, I think he put up a couple $100,000 worth of BHP, so a lot of money, particularly back then. And he actually didn't draw down on his loan, but because his assets were kept as security for the business as a whole, it was sold. So the one thing we say to clients now, that look, if something goes wrong with our business, with Consortium Private Wealth, that you own your assets directly in your name, in your chosen entity. No one sits in between.
And that is a really great point, I think, and clients normally are sceptical about, we design these portfolios and they say, so we send you this lump sum of money, if it's, for example, $300,000, we send that to Consortium and then you invest it, but no, the money never comes through us. It's always in a bank account in your name, personally. So, like you said,
Yeah.
anything can happen to us, and the money's safe in their name.
Yeah.
I think that's an awesome point.
Yeah, so that was, and there was another, I said, by default we got to there. It was probably wasn't one I was thinking of, is that corporate collapse risk. But,
Yeah.
but that was just consequence of the way we do it.
Yeah.
The other one was where I saw one of the banks, it was National Bank via MLC. So the National Bank brought Aviva during the global financial crisis. So that meant that National Bank had MLC, their products, and then there was Navigator, their products. And what these big corporates would do, I said they didn't want multiple products costing a lot to run doing the same thing.
Yeah.
And what the bank did was they just closed stuff down that was not in super, out in people's individual names,
Yeah.
realised capital gains, hurt their tax, hurt their centrelink outcome in the name of just getting efficiencies for themselves.
Yeah.
And again, by default, we avoided a lot of that,
Yeah.
which is flaws in corporate behaviour more than anything.
Yeah.
Where they say, right, we're going to get this efficiency, let's get rid of that, and you advisors deal with it, and you the clients cop it.
Yeah.
And it was so nice not to be there for those times.
Yeah.
Which, yes, a lot of my mates in the industry had to do a huge amount of work to try to get the best outcomes for people, and this was forced on them. This was not a choice.
Yeah.
That's happened numerous times over my 27 years in the industry. It's not common, but again, when the clients own it directly in their own name, there's nothing to be closed.
It's you own the share unless you want cash to go on a holiday. It's going to stay invested.
Yeah. So I suppose where we got to was, we invest directly as possible.
Yep. Avoid all the fees and all the products.
Yeah, and that's probably the next point was the fees.
Yeah.
When you had the product, the administration platform, then you had the managed funds or ETFs, whatever it is, and then you had the advisor. It was a big list. There's a lot of mouths being fed from the fee point of view.
Yeah.
We made a point that we were able to get rid of the administration, and this is where it's not the norm, because we do a lot more work. We are the mail house for our clients.
Yes.
So if we build a portfolio of Aussie and international businesses, and their entity, their super fund, their self-managed super fund, or whatever entity it is, they own it directly, which means there is a flow of paperwork, a flow of emails, tax file numbers, lots of things to be done.
Yeah. If we want to make a recommendation, like a buy for a business that's come back 30% in the share market, that's us getting in touch with all our clients, getting the consent, and individually purchasing that. So it is a lot on us as a business back end, but the benefit for the end client is, in our opinion, worth it.
Well, I think there's a great example where Amy took on a new client, a Melbourne advisor, and I think the total cost was around just under 2 mil in investable assets, and it was close, I think, 42 or 3,000 per year. So that is product, managed funds, advisor, and we were able to shave off 16 grand in that. And there's still some product in there. It wasn't appropriate to get rid of all product, but all of a sudden 16 grand per year, compounded over a lot of years to come. These are big numbers. Yeah.
And oftentimes it is really hard to even see those fees, and the client was completely unaware of it because there's just so many layers. You look at just the platform fee and you think, oh, that's okay, but you don't look at the individual investment options under that, and then the ex-advisor's fee on top of that. It just...
Yeah, it grows, and we've seen that a number of times where people have come to us and we've just been able to lower fees. And actually, now just remembering the case studies and experiences as we go, I remember they were clients when I first started, all the way back, and they were in a Colonial. When I first started, I was licensed under Colonial Limited, so they had a Colonial product, and they were in the Rothschild's property fund, the BT International Fund, the Colonial First State Imputation Fund, and then some conservative fund, which I can't remember what it was. And their accountant said, hey, Mr. and Mrs. So-and-so, we would like to roll that over and we'll put it into a self-managed super fund. So this would have been around 2000, 2001. And within that self-managed super fund, we can buy direct shares for you. You can own farming land. These were farmers, farming land in the fund as well. And gee, that sounds fantastic. It was quite a romantic thing to do. And so they went ahead and I lost them as clients. I caught up with them probably 4 years later and I said, how did it go? And they said, oh, can we show you the tax return? I said, no worries, that'll be interesting. I'd love to see what's happened afterwards. And I'm not sure why I was catching up with them. They weren't clients after that. But when I had a look at the tax return, I opened it up and I had a look, and it's the exact funds that I had were replicated in the self-managed super fund. And that annoyed the hell out of me, because all that happened was a whole layer of fees and complexity was added because the accountant obviously had a conflict, because they get paid for doing a tax return and the audits. And I thought, thanks a heap. You just added more fees and complexity, and there was no value added whatsoever. You used it was in a wrap account with the same products. So every time I see a self-managed super fund, you know, with Macquarie wrap or something, they'll go, yep.
It's such an
let me add it.
It seems, and it is really, it's such an easy win to give people to just eliminate that large amount of fees, which they don't even realise they can do, but it is that easy, especially self-managed super fund. It's an entity. That entity can own any asset, same as an individual. So
as I said,
it's just an unknown.
I'm not saying that the product world is wrong. There's just alternatives. And I think, you know, and people listen, you know, if there's advisors listening to this, they might say, well, that's great, Rob, that, you know, how can you know, performance-wise, you've probably done worse than other professionals that, you know, the fund managers. And in reality, that hasn't been the case over the last two and a bit decades. And in fact, a lot of scenarios that if my clients were just in index world and they missed out on some of those portfolio makers, the outcome would be substantially less. But that's the past, and we can't hang our hat on the past. It means nothing. We've got to look to the future. So when we talk with new clients and they say, oh, tell us a return or tell us what's been done in the past, you generally won't do it because it's completely irrelevant. All right, well, another question, Rob. You mentioned at the start of your career that you were licensed with the NAB Bank and Colonial. Why are we now self-licensed? Ooh, good question. So there is a bit of a history here. So it was Colonial Mutual back in the day, and then Colonial Mutual was then demutualised and became a listed business. So the policy holders were essentially the owners of the business. So the people that owned life insurance policies then became shareholders, and they still had their insurance policies. So that happened, and then Peter Smedley was the CEO, and he was buying, I think it was Prudential and all these other Legal and General. He went and scooped up all these other life insurance businesses, and then ultimately he built it up, and it was sold to the Commonwealth Bank in 2000-ish. So Colonial shares all turned to CommBank shares, and then we were under, you know, it was still Colonial, but we were under Commonwealth Bank's banner. Then I went across to Financial Wisdom, which was an internal shift to a different licensee, because I didn't find that, you know, Colonial was back in the life insurance days, and I wanted to get into the financial planning days. And a chap, Theo Christopoulos, a guy I absolutely respect tremendously, was great guidance for a young Robert Gowdy at the time. But whenever banks get involved, they stuff things up. So what we did as a group, there was 19 businesses, Theo and Brian, and we set up independently ran and owned business called Meritum Financial Group, and that was the new licensee. And that all went really well until it was sold to the National Bank. And I won't whinge about that. because as a shareholder there was a payment for that.
Yeah.
So I cannot complain. But ultimately, again, banks will stuff things up, and that's where ultimately, I suppose, where we had to part ways with the National Bank was the fact that they didn't like the business that we did.
Yeah.
So they had the licensee. We were authorised under, Meriton still at the time.
Yeah.
So they were responsible for my advice.
Yeah.
And they weren't happy that we were going direct. We weren't using MLC Masterkey. We weren't using their products.
Yeah.
So we were all risk and no reward.
Yeah.
And so, yeah, we agreed, and I forget the chap's name I dealt with at the time, it was a mutual agreement that we would move on, that our model didn't suit.
Yeah.
And that's why we went self-licensed.
Yeah.
And that meant that we didn't have to be in a constant state of argument about, no, we're not using your products.
Yeah.
Where it's not appropriate,
yeah.
We'll do what's right. And quite often that was where we were all risk, no reward.
Yeah.
And there were so many clients where I was explaining, and this is quite a few years ago when we went self-licensed, and then clients would say, oh, why have you done that? And I said, well, guess how much money, the National Bank, our licensee takes from your funds. And they go, oh, geez, Rob, I would hate to think. And I'd say, well, it's actually none. That's the problem.
Question.
Yeah, it was a trick question. And yeah, I said, we were all risk, no reward.
Yeah.
Yep.
Yep. And now we're blissfully recommending the products that we think are in the client's best interest and don't have that conflict to recommend something that is owned by our licensee. Cause
yeah, and back then when, things have definitely changed then, but the super fund industry or the platform industry is very competitive.
Yeah.
So I think they're all very similar now, that it doesn't matter which one's out there, they're all really, the fees have come down substantially. But there is still, cheaper than others.
Yeah.
And that's part of our job where, where a self-managed super fund is not appropriate. We set up very few these days.
Yeah.
We take over the management of a lot.
Yes.
More than what we set up.
And that probably is because, like you said at the start, 97% of our industry will go self-managed super funds still and then have all those products within instead of going direct. Then people come to us and say, can you please review this fund? And we go, easy win here, get rid of fee, get rid of product, get rid of fee, product.
Yeah.
And people are very, very happy with that advice and want to go the direct option.
Yeah, and because we are still, whilst it's self-managed or even as it's not within super, it's in a trust, joint names, individual names or a company, that we're doing the work for them. It still feels like, they're not getting the paperwork, we do the work. Because we want our clients to be going out having some fun.
Yeah.
But the one thing that I've always said that, if we can lower fees each year, that's guaranteed.
Yeah.
We cannot guarantee returns. No one can.
No.
If so, and I still remember this is when Commonwealth Bank owned Colonial First Aid, which is now called First Settler. I miss some of the name changes, and I think that's been sold off elsewhere. But yeah, I remember someone saying that after a good year in the market and one of their funds returned 20%, there is a banner in the branch, stating, this is what happened in the last 12 months as a sales thing.
Yeah.
I see that and say, is now the time to be careful? Yes, of course it is, after a big run up. So, but yeah, returns are never guaranteed, but if we can save 5-10 grand a year, or for your client, Amy, 16 grand a year, you can lock that in.
Yeah.
That is a guarantee.
Such an easy win.
Yeah. So that's broadly, obviously, the chat that James Wrigley and I had.
Yeah.
He's obviously quite interested because he runs a business like we do.
Yeah.
And the Ensemble podcast was more for advisor.
Yeah.
And what are other people doing? But I think it's important that that everyone knows that there is different models and different ways of doing things. And some of the conversations that Amy and I had with people all over Australia is, I think people find it quite refreshing that there's different approaches.
Yeah. And that going direct is thing, and we can be that mail house, and they still can be quite hands off, even with that self-managed super fund. Which there's still obviously trustee duties to maintain, but we help drastically do that.
Help. We
are the
between
mail house.
We are the mail house. We work directly with the accountants.
Yeah.
But the only time that we would be recommending it, we're actually winding up a few that have been very property orientated, but it's going to need to be 1 mil plus before we think it's worthwhile to do.
Yeah, definitely.
Great. Thanks, Amy.
Thank you, Rob.
Excellent.
That's a great explanation for everybody.
Yeah. So, guys, you can find Amy on, where are you, in terms of social media and I suppose your personal education to clients?
Yeah, you can find me on Instagram and TikTok at The Wealth Diaries, and you can find yourself on
Yep,
those as well?
Rob Gowdy. Be careful of the impersonators out there. There's a fair few of those dodgy
Everybody
accounts.
wants to be you, Rob.
Yeah, the only reason why anyone would consider impersonating me is because they know the people who are listening are interested in investing, and so that means that they're scammers. They're trying to get money out of people. That's why. But check out our YouTube channel. Some of you might be watching or listening to this on YouTube. We've got 700 plus videos there that we've done over the last 13 years. So it's been an awesome labour of love, our YouTube channel.
Yeah.
And also, on Instagram and TikTok. And thank you for the people that join on the live.
Yeah, and normally our videos are educational about retirement, investing, so they're not quite like this one. This is a bit of a once-off of how Consortium works as a business, and it's a great thing that now we'll never ask for your money. So if there's a Rob Gowdy on TikTok that is asking for money, they're a scammer.
Yeah,
always keep it in your own name.
Yeah, it's not me.
No.
Terrific. Thanks everyone.
Thank you. Bye.
Bye.